Wealthy and Wise is your guide to value investing, powered by Teaminvest.
Hi, welcome to Wealthy and Wise this week. Lovely to be with you. I'm Nadine Blaney from AusBiz. Well, today we're diving into a topic that's top of mind for every investor, volatility. Last week, more than 1 in 3 Australian stocks on the 200 traded up or down more than 5%. So as markets swing, prices wobble, and headlines scream, what does all this movement actually mean, and how can value investors use it to their advantage? In our first segment, we'll unpack volatility itself, what drives it, how incentives and market structure perhaps amplify it, and when market swings reflect real risk versus sentiment. And then we'll take a practical turn looking at how disciplined investors can exploit volatility to create long-term value, manage risk, and make smarter decisions in uncertain markets. We'll also answer one of your questions. So let's get to it and add some value. And joining me in studio is Andrew Coleman from Teaminvest. Welcome back. Nice to have you here. Also joining the conversation is Mark Humphery-Jenner. He's from the University of New South Wales Business School. He's an associate professor of finance and will help us see past the headlines to understand what volatility really is. Mark, a very warm welcome to the program. So let's start at the beginning. How do you define volatility?
Well, to me, volatility just refers to the movement of asset prices. So, for example, it could be a fluctuation up, a fluctuation down. It's the type of movement that typically is unexpected, a movement that you don't foresee and is going to potentially be something that will change your returns, either for the better or for the worse.
Okay, and so when we're thinking about volatility, that's, the concept. Why, in your view, and how it's measured, is it sort of synonymous with risk, or at least we treat it like that?
Yes, so volatility and risk often go hand in hand. So when we're talking about risk, there's really the unexpected movement. So it could be, for example, a short, sharp movement that you didn't foresee beforehand, and then creates a change in the price that is then relatively stable. I'll give you an example. There might be a risk that there's a takeover announcement, which could be really good if your company happens to be the target. However, there could also be risks that are negative. So a risk, for example, of a tariff shock, as we saw on April 2nd of 2025. Volatility goes hand in hand with those risks, those unforeseen circumstances, where the volatility are those price fluctuations that occur when you get those uncertain or unknown events.
Yes, but in real life, volatility to the upside isn't a risk. So why do we tend in finance to treat it that way?
Yeah, so volatility to the upside, I guess it to some extent is a risk. It just happens to be a really good risk, right? And there's the type of risk that we think, well, that's great to have. And we really focus on those downside risks. And for many of us, that makes a lot of sense. However, the main reason, or one of the many reasons, in fact, that we focus on total risk from a mathematical perspective is simply a bit easier to model. And in fact, we don't know for sure whether the future event that's going to occur is going to be upside or downside. So given that we don't have that perfect foresight, we need to consider all risks and all potential fluctuations in prices. But of course, we would ideally like to try to maximize our chances of getting access to those good risks. And this is where the somewhat fraught field of things like takeover prediction comes into play, right? Where people are trying to predict a good risk, in fact, reduce the probability of getting a bad quality company, increase the probability of a good quality outcome, thereby getting access to the good quality volatility they want.
It's so interesting. Andrew, as a value investor, do you see volatility as risk?
Well, no, but I think that's a really interesting point, and Mark's touched on it, and I think it's worth drawing out. From a mathematical point of view and a finance theory point of view, we use volatility as a proxy for risk because when we're doing large series analysis, it's really hard to understand what a specific cause at a specific time is. In other words, we can get correlation, but it's really hard to understand causation. And so from that point of view, the easiest mathematical calculation is to look at what changed relative to what was expected. So if you look at share prices, for example, that's how did tomorrow's share price react relative to today, the change in that share price. And when you're putting that maths into your equation, it's much easier to deal with volatility, which is the square than standard deviation in the statistics, which is obviously the square root. And as a result, you end up in this beautiful model that has a huge amount of value, but is unfortunately, I think, really misunderstood in the practitioners within financial markets as opposed to the academic theory, which is that volatility becomes seen, the change in assets, volatility, becomes seen as a proxy for risk, even though it's direction independent. In other words, as Mark said, it's equal on the way up and on the way down. And of course, that's logically inconsistent. I mean, if you're an investor and your expected return was, say, 6% on an asset, and you got 9, that's not risk in the real world sense. That's great. On the other hand, if you got 3, not so great. But those two are treated exactly the same in the way the formula is calculated. It's why I have great hysterics laughing at, in particular, how regulators approach this and reviewers of assets, where they use volatility to determine whether a performance of an asset is good or not. Because I always ask them the sort of simple question, which is to say, I can guarantee you an asset with 0 volatility, and that would make it have incredibly low risk. That asset is, I take all your money and never give anything back because I achieved exactly the expected outcome. Now, for the investor, that's 100% loss of capital. But from a mathematical equation, it's 0 volatility.
Okay, all right. Mark, we talk a lot about volatility. Are markets genuinely more volatile today, or do we just see the outcome of some of the risk faster?
Well, certainly there's a lot of salience effect. So, for example, when you see volatility raw today, it obviously really hits home a lot harder. So say, for example, we were all the way back in April of 2025. We observed the tariff hit. Well, then at that stage, we would have felt the impact of volatility significantly greater. So absolutely, there's a salience effect, a behavioral aspect to this. In terms of whether markets are more volatile or less volatile, well, it really depends on when you're comparing it to. For example, if we're comparing today, right now, to say the global financial crisis, we would get movements day on day that were potentially like 2-3%, and that was not uncommon at that point. Well, these markets are probably less volatile, but they're probably more volatile than some really peaceful times as well. So it really is going to change a lot over time. A lot of the real art of it comes down to thinking about what is the volatility going to do, and more importantly, does that actually affect your portfolio allocation decisions?
Yeah, I think Mark's point there around how it affects your portfolio is, and we've talked about this in the last 2 episodes, is so incredibly important. I mean, volatility is a concept, and it's a really good way of modeling what's going on. We can describe a market through a combination of expected return, so a general trend, and the volatility around that. So it's a very useful academic construct, and it's very useful to do all sorts of things. But from your portfolio point of view, volatility only matters at the time when you're either buying or selling. In the same way as when you go to buy from a store, the price that the store is selling a good for on the days you don't shop at the store is irrelevant. And the same thing happens with the stock market or any other asset market. So, if you're a regular trader, sort of an intraday trader, the opposite of a value investor, volatility becomes both your enemy and your friend very quickly because it's going to affect your returns in an astronomical level. On the other hand, if you're a long-term investor and you're trying to look through the cycle, the odds are that intraday or intra-week or intra-month volatility is probably not going to have any impact in your overall return, right? Because the long-term trend is going to have a much greater weight in the outcome than any individual volatility, daily, weekly, monthly. The other thing to think about as well with volatility is a concept that just describes difference from an expected value. So when we're talking about investing, there's actually 2 volatilities, and I think we often mix the 2. There's volatility of price, how much has the price moved, and that may not be relevant long term. And then there's volatility of earnings. How much does the company's profit change up and down in a period? And I would argue that for a value investor, volatility of earnings is critical. It's very difficult to make predictions about the future if what you're predicting is unstable. But volatility of price is simply your friend. It gives you an opportunity to enter or exit in a way in which you otherwise wouldn't.
Okay, Mark, back to some of the more structural, perhaps, influences on volatility. Has passive flows, the rise of ETFs, heightened volatility, algorithmic trading, liquidity cycles?
Yeah, so some of those factors will influence volatility, but they'll do so in, well, sometimes slightly offsetting ways. So let's take, for example, the rise of ETFs. In some ways, these help to dampen volatility, at least at an initial stage, if everyone is going into the same asset. The main area in which they heighten volatility is it can create a bit of a perpetuating loop. For example, say you've got a valuated index, and then say we'll use S&P 500. Say, for example, hypothetically, Google were to significantly decline in price. Then a lot of these exchange traded funds will need to sell down Google in order to reweight their portfolio. So it can help to amplify that volatility. Similarly, if we look at single asset ETFs, so Bitcoin is one that's particularly topical recently. We've seen Bitcoin go down significantly. There are anecdotal reports that at least some of the ETFs, and if not ETFs, at least some of the custody companies and some of the companies that are effectively managing large books of Bitcoin, some of those have involved a degree of leverage. And that leverage and that levered exposure can amplify the impact of a price movement, both on the way up and on the way down. So ETFs have certainly had an impact on volatility, although perhaps from a trader's perspective, particularly if you're long-term, in many ways, you can almost navigate around that type of thing. In terms of algorithmic trading and high-frequency trading, well, algorithmic trading can be done in a few ways, right? One way is just to try to minimize your price impact. And in that case, that type of algorithmic trading probably isn't really influencing volatility too much. But if we're talking about high-frequency trading, where you're using algorithms to try to make a profit rather than minimize your price impact, then that high-frequency trading can exacerbate volatility. So, for example, if you remember back to the flash crash, where some algorithms went a little bit haywire and exacerbated a significant downturn, then certainly algorithmic trading and high-frequency trading can make things worse. But perhaps over the long term, the impact is probably not that significant over the long term, especially when you consider the fact that some of these algorithms, in fact, can help to create liquidity in the market.
Yeah, and I think it's a really good point there that the type of volatility matters depending on the type of investor you are. And there are three elements to what really, therefore, determines whether this is going to be impactful to you or not. The first is the direction of the volatility. In other words, there's volatility around a trend, but is that trend up or down? The second is the time between those elements of volatility and how does that compare to your range? And then from the perspective of a value investor, specifically, whether those two are going to end up in your favor or not in terms of your buy and your sell price. And we've got a couple of charts that we put together before that I think display this quite reasonably, graphically and simply. The first is if we just have a look at two companies, theoretical companies with the same volatility, and I've very kindly named them company A and B because don't let me name anything, I'm a finance guy. They have identical volatility. So you'll see on the chart there's a blue line and an orange line. Company A and company B have identical price volatility. So they're moving up and down at the same rate, but they have opposite directions. So company A is volatility in a rising direction. In other words, the long-term trend is for a growth of share price, and company B is the same volatility for a long-term downward trend. Now, if you take a snapshot at any point in time, that volatility may be your friend or your enemy. But of course, what matters more than the intraday volatility there to the investor is where did you buy? First, where did you sell? So it's going to be a lot harder to make money out of company B, which is shrinking its share price, despite the volatility, as it is in company A. So I would argue there that what that shows is it shows that volatility demonstrates the path of the movement, but says nothing to a long-term investor's goal around maximizing your future wealth. And the second chart, I think, shows this even simpler, which is to say, let's take company A in the scenario we've used before, and a new company, company C, that shows zero volatility whatsoever, perfectly smooth price action. Now, of course, that never happens, but theoretically it could, right? And again, what shows there is it shows that even though there's more volatility in company A, and therefore technically more risk, it's clearly the better investment because the path of that risk is in your favor. And that's really the challenge, I think, to separate when you're using volatility as a concept, the risk of the intraday volatility or long-term volatility, whichever measure you want to use, from the outcome, which is maximizing your wealth. Because really the risk to an investor, as opposed to the mathematical model, is the risk that you lose money. And losing money isn't just about intraday movements, it's about the overall path over time.
Yeah, I think this kind of dovetails with the viewer question that came in. But Andrew, as an investor, stocks in your portfolio, even some of the stalwarts, I'm sure, have very volatile days. So when, particularly given we're in reporting season, do you decide whether it is an emotional sentiment driven overreaction or some sort of structural damage to the thesis, or given the conversation, potential upside as well, structurally?
Yeah, I think you've got to go back to first principles and say, is this a good asset, firstly, and then obviously a reasonable price, and therefore if the price is better than reasonable, buy it, and if the price is not better than reasonable, don't buy it. I think what's interesting, of course, from that point of view is, again, coming to a point we've drawn out a few times, we overcomplicate things in finance, right? Like stores go on sale all the time. Woolies and Coles have items on sale all the time. We don't give that a fancy name and call that price volatility of the SKUs. We just call it on sale. Isn't it the same thing when it comes to share prices? It's just that because we're doing large modeling, we have a term called volatility that lets us describe that in a more detailed way. But it's the same element.
Okay. Mark, only because we're going to lose you for time. Now, this is a bit of a trick question, but if you could, as an investor, a long-term investor, pick an ideal market environment, would you prefer it to be stable or volatile?
Well, probably volatile in reality. The reason I say volatile is because that volatility, it often goes hand in hand with other things. So it's not the volatility that I per se like, rather it's what the volatility might imply about the environment in which I'm investing. So for example, you get price movement when you've got a more dynamic investment and economic environment. So for example, the Nobel Prize winners in 2025, well, they emphasize the idea of creative destruction, the idea that when new businesses come along, old businesses might go by the wayside. And what does that entail? Well, that entails volatility. So the volatility is a natural outcome of that occurring. So if you've got a dynamic environment where you're going to get more promising companies, that is going to need more volatility. By contrast, if you've got not much volatility, well, it tells us that there's not much change in earnings, not much growth, you don't have a really dynamic environment. And therefore the volatility is symptomatic of what you really want as an investor, a dynamic stock market and a dynamic economic world in which you can invest.
Well, it is fascinating, and I'm glad I asked that last question. A huge thanks to you, Mark Humphery-Jenner, for joining the program. Appreciate your time. Andrew Coleman will stick around after the break, where we'll delve into some volatile stocks. Nick Cummings from Intelligent Investor joins us next. Volatility is one of the most misused words in finance. Perhaps we learned a little bit more about it in the previous segment. As we said, it's often treated as risk, but volatility is simply deviation from the expectation. It actually doesn't care whether the surprise is good or bad. So why do markets fear it? And does volatility reflect real danger or just human reaction? Today, we're unpacking what really drives volatility and whether investors should be afraid of it at all. A very warm welcome back to Andrew Coleman from Teaminvest. Good to have you here. And joining us as well now, Nick Cummings from InvestSMART. Really appreciate having you with us there, Nick. I'm going to start with you because we talk about volatility ad nauseum. Is volatility, in your view, your enemy or an opportunity?
Well, I think for the prepared investor, it's definitely an opportunity. I mean, if you look at it as the enemy, I mean, you're sort of wanting a market that will be efficient all the time and fairly priced all the time. And for a prepared investor, that's just not the opportunities you want. So you want to see volatility in share prices because that gives us the opportunity to buy wonderful companies at discounts to their intrinsic value. And without volatility, that just wouldn't exist. So I think investors have got to brace it. It's sometimes hard and it can hurt, particularly when other things are going up and it's your portfolio under pressure. But no, I think it's something to embrace and something that at the Intelligent Investor we look at as an opportunity.
Okay, so talk to us a little bit then, just to maybe take a step back, Nick. What's your sort of philosophy at Intelligent Investor, or how would you describe yourself?
Yeah, so we're value investors with what I would say is a tilt to higher quality companies. So yeah, it's probably worth stepping back a little bit and defining what we consider value investing. And For us, that simply means buying something at a discount to what it's worth and with a margin of safety. So we're not typical, the old school Benjamin Graham value investors that are buying cheap price to book values or, the last puff of a cigar bar. We are generally looking for higher quality businesses, but we're patient and we stick to our discipline. So we don't want to overpay for these businesses, and that's particularly important when markets are exuberant. But so we're value investors with a tilt towards quality.
So Nick, let's talk about some companies that I understand are in the portfolio, and that includes some listed companies overseas, because what we've seen is this real volatility, this real sell-off happening in software stocks, in tech stocks, in sort of tech-related stocks. So how can we look at the sell-offs that we've seen for the likes of Car Group, for Auto Trader, for Rightmove?
Yeah, so for us, we own these businesses, throughout our portfolios, and so this selling, particularly this threat of AI, has sort of wound up in lots of sectors, and one of them is the classifieds group. So, like, Car Group is down 40%, Auto Trader has halved, but in our view, that's the volatility of the market, and the actual fundamentals of these companies haven't changed. So if you look at what a marketplace actually is, it's just designed to reduce friction between the buyers and the sellers. And we think the classifieds do a really good job at that, and that's why they've been wonderful businesses for a long time. We actually view the incumbents as the best place to utilize AI agents. And there's a few reasons why. I mean, the first is they have a unique inventory position. Because they're the market leaders, there's more vehicles on these platforms than there is their competitors. So if you were to exclude searching, you'd be doing the consumer a real disservice. The other big reason is proprietary data. So they have a couple of decades worth, both Car Group and Auto Trader, of vehicle transaction history and consumer habit patterns. And we think AI agents that they use internally are actually best placed to improve the customer experience versus an external service that doesn't have access to that data. And then lastly is direct traffic. Both of these companies really get their audience not from Google, but it comes directly to them through their apps and their websites. And this consumer habit has been built over sort of 2 decades. And now virtually all their traffic is direct. So I think for Auto Trader, it's something like 5 to 10% of their traffic is paid, and the rest comes directly. And we think that's a real advantage. And at the moment, you haven't seen any disruption from the large language models or consumers changing their patterns. But we can buy these businesses now for half what they were worth 6 months ago. And in the case of Auto Trader, on a multiple of 10 times earnings, which we thought we would never see outside maybe a depression. So it's pretty exciting.
Yeah, so there you go. There's case in point, in Nick's view, an opportunity being brought about by volatility. When you look at those classified businesses, and I don't think you hold some of them, so no, you can just talk in general. What matters most to you, earnings stability or price movement?
It's a great question. So look, I think it's, as we talked about in the last segment, it's worth separating volatility of price from volatility of earnings. So from our point of view as long-term value investors, what we're really wanting is a company that has really strong and stable growing earnings. And Nick may agree or disagree with some of our definitions of that, but that's what value investors in general want to achieve, where the market gives us an opportunity to buy that business at a discount. And that really means we need a combination of earnings stability and price volatility. So when we're talking about volatility, normally in the market, we're talking about price volatility. So from our point of view, 2 thumbs up. If we're talking about earnings volatility, 2 thumbs down, because really we're looking for that upward movement of earnings whilst we're getting price volatility, enabling us to go in and buy what we wanted from the store at a discount. And I would agree that in the case of the classifieds, certainly what's happened over the last little period, potentially due to AI fears, potentially due to mean reversions of PE ratios, is that the earnings have continued in the majority of cases to march on a very nice steady upward trend. Meanwhile, the share prices have done huge peaks and troughs. And that's always what you're looking for, whether you're a value investor in a Teaminvest or Buffett point of view, or a value investor in a Benjamin Graham point of view, or a value investor in a growth point of view.
Andrew, would you ever look at a business if there wasn't stability in earnings?
So the interesting thing is, and we've talked a little bit about this before in other ways, but the requirement to be a value investor requires you to make a prediction about the future. You have to predict where you think a business is going to be in the future. And the sad reality is that predictions that are not based on history sound really lovely in a spreadsheet and look really beautiful on a graph, but they're usually wrong. So realistically, the only way you can know that something is likely to be worth or have earnings worth more in the future is if they've got a demonstrated track record of growing those earnings at a steady clip. And in fact, there's research that was done by Dremen and Berry, and we mentioned this last episode, that showed that analyst forecasts on average for the United States were materially wrong 1 quarter ahead 80% of the time. And again, that's not an indictment on analysts getting things wrong. That's a question about trying to predict the unpredictable. So if you want to be a value investor and you want to have a firm, likely outcome, a virtual certainty of outcome that earnings are going to grow, you need virtual certainty of earnings growing stably in the past.
Mm-hmm. Nick, what's sort of a portfolio company that you reckon has that, I guess, combination of earnings, consistent earnings, stability in earnings, but also, bouts of volatility?
I mean, the sectors we've spoken about are probably the best example. So another business we own is Constellation Software, and this is probably a bit unfamiliar for most viewers, but this is a Canadian software company that acquires vertical market software. So think like niche, tiny businesses where they're the number 1 or 2 player with very small profit pools. The track record of this company since listing in 2006 has been fabulous. Return on invested capital has been routinely above sort of 20 to 25%, and earnings have sort of marched up with it. So the earnings consistency here has been tremendous, just like they have with the classifieds business. But the price volatility we've seen recently probably doesn't go with how we're assessing the moats of these businesses. So in the case of Constellation, their share price has fallen by 2/3. And it was expensive, as sort of Andrew alluded to. Some of this quality sell-off is PE revision. It's probably warranted, but in some cases we think it's gone a little too far. And now you can buy Constellation on 15 times earnings instead of 40 times earnings that it was trading on in about July last year. So that's sort of an example of the earnings trajectory has been steady and growing and hasn't changed, but the share price volatility has changed an awful lot. And we think we're pretty excited about that opportunity as well.
Yeah, okay, interesting. Now, Andrew, I know you've brought some charts along, and one of which is Coles. So it's not quite a Constellation Software by any stretch of the imagination, but stable earnings, very stable price multiples. Is this what an efficient market looks like?
Yeah, I think they're probably the only thing Coles and Constellation Software have in common is the first 2 letters of their names. But yeah, I mean, look, so I've used Coles as an illustration of, to your point, a relatively efficient market. So what you have here is a company whose earnings have been pretty stable. That's that grey line showing, earnings pretty much the same over that period. And a share market that has valued those earnings at approximately the same amount over that period, with the exception of 2019 in the graph, which was sort of the stub year that it listed. That PE ratio has been in a very narrow band. That's the difference between the light blue and the dark blue graph. So what you see there is stable earnings, stable share price. In other words, limited volatility of earnings and limited volatility of share price, which is probably why Coles as an investment, it's a good company, but it very rarely shoots the lights out because you're not going to get big earnings growth and you're not going to get big PE growth.
Andrew, can a company be too stable to really offer any meaningful growth?
Yeah, absolutely. I mean, look, from an investor's point of view, your return is driven by 2 things. It's the dividend yield you receive and any share price appreciation that you can earn, right? So from that point of view, for a company to give you a good investment, if you want a return of that investment of anything north of sort of 5 or 6%, that's not going to come from dividends alone. And if you're aiming like we are at Teaminvest for 15 to 20% per annum on a compounded annual basis, that's not coming from dividends unless we have a major stock market correction. So from that point of view, a company that's growing really slowly even if it has a really good payout ratio, it's never going to be able to drive meaningful return unless you have share price volatility. So in our Coles example, Coles is a wonderful company. It owns its space in the market, but it's not going to give you as an investor meaningful returns because it's not growing meaningfully beyond inflation. And the market's efficient enough that there's not that opportunity to arbitrage a low entry point, a low PE at purchase with a high PE at exit.
Yeah, okay. Now, you've brought another chart, and this is for Bapcor. Very volatile earnings. Not lately, but until fairly recently, it had pretty stable share price. Why did Bapcor prove to be so dangerous?
Yeah, I think that's the exact opposite of Coles, right? So we had in the Coles example this beautiful sort of steady earnings, not growing, but steady earnings and steady PE. In other words, that the market volatility of price reflected the volatility of the underlying earnings. It was efficiently valued. And of course, in Bapcor's case, you have the exact opposite. You can pull the Bapcor chart up and you can see that that grey line of earnings per share is jumping all over the shop. I mean, that's serious volatility. We've only got sort of 10 data points here, but to see a curve that has 2 peaks and 2 troughs in 10 years out of 10 data points tells you that this thing is jumping up and down all over the place. Meanwhile, for most of that period between 2016 and 2023, the PE ratios were in a very narrow band. In other words, the market was saying there is no price volatility, even though there's big earnings volatility. And that's a big risk because all it takes from an investor's point of view is the market to wake up for that volatility of earnings, usually on a bad result because the market tends not to reward you for a good result. It tends more to hurt you for a bad result. And your share price, your wealth, can be materially reduced. And I would argue that's exactly what happened in Bapcor. And it's why it's down from its peak around sort of 80%, despite theoretically being a blue chip, because, the earnings in the end are going to drive the value of the company.
Yeah, Nick, as a value investor, I'm sure you can agree with many of those points. You don't have to comment on Bapcor in particular, but is it sort of the type of company that you can fall into the quote unquote value trap with, that you're looking at the share price, but perhaps, at your detriment, ignoring the fundamentals?
Yeah, I think it's the case in point of a value trap. And it's not a business I've followed closely, but it just seems to me like it is very defensive, but that does not always mean that there's no earnings volatility. And we can be susceptible as investors to classify a business too quickly as a defensive business where there's very little earnings growth, but we also expect very little to change. And even if you look at a company like Woolworths, where that has a defensive earnings stream, there's no doubt. If you rewind 6 months and look at their last result, earnings actually fell a lot. So the top line revenue doesn't change an awful lot. But even in a defensive business like Woolworths, net profit can bounce around year to year based on operational investments. I think there was actually some theft in the stores. A lot of other things can change. So it's important that we don't just set and forget. And I think a few investors maybe have done that with Bapcor, just assumed it was a defensive business, even though, as Andrew said, there has been a lot of earnings volatility. So you've got to be careful. There are value traps everywhere, and just buying the cheapest stocks is we don't think it's the best way to actually make a long-term compounded return.
Got it. Okay, so Andrew, here's the challenge. What is a company, or are there companies out there that can have stable earnings, but like a wide and fluctuating PE that would still sort of pass muster?
Yeah, I think the vast majority of companies with stable growing earnings actually do fall into that category of companies whose PE ranges move somewhere between sort of 25 and 50% per annum, which is an insanely large number if you believe in the efficient markets hypothesis. And a great example of that is Data3, which is a pretty boring but wonderful provider of managed hardware and software solutions to large corporates and governments. So it's about the most boring defensive kind of operation you could be running. No offense to the team at Data3, they do it brilliantly. And you can see that grey line of earnings has been on a steady upward march, probably for 25 years now, but certainly for the 10 years of this chart. And yet, despite that, have a look at the gap year to year between the low and high PE in that company and the gaps between years. Some years the overall band is big, but it's at a low level. Other times it's big and at a high level. Now, as a value investor, that's exactly what we want to see. Why? Because we know that the earnings are growing and predictable, and they're growing at a rate that will generate us a good return. And the bipolar nature of Mr. Market keeps offering it to us on sale. It's the example of walking past your favorite store and seeing them every second week selling everything for 50% off. What a wonderful company to want to buy, and what a wonderful company to want to own, because you know that at some point in the future, as that chart is showing, Mr. Market is going to get exuberant and come in and say, forget what price I was offering it to you for, I'll pay you 3 times that to take it off your hands. And it's why Data3 has generated sort of a 10 times return for shareholders in the last 10 years.
But I think it's really interesting because both you and Nick are talking quality, and I can think no higher quality company in the tech space. I mean, I'm casting a wide net, but than TechnologyOne. So that is a company that is quality. It's got stable earnings. It continues to set goals and achieving them. But its price has moved in accordance with that. Or I would probably think you'd argue move too much.
Yeah, I mean, I mentioned before in relation to Data3 that the market can be a bit bipolar. It can be very down on a company for a while and then get very excited about a company for a while. And I think TechnologyOne is just a perfect example of that. And I think we've got the chart here of TechnologyOne, but I agree with you. In terms of its earnings path, that stability of earnings growth is second to none on the ASX. I think it actually is the most stable. There may be 1 or 2 more. I haven't scanned every single company. But have a look at the PE expansion that occurred as everyone got super excited about SaaS and super excited about where the world was going to go with technology. And I think the quote that I saw in the AFR was, all companies will be technology companies. There won't be anything left except technology companies. And the market got exuberant and bid it up to a PE of 100. Now, we've spoken a lot on this program, you and I, and on the call and in all sorts of other shows about this concept of PE mean reversion. And you can see that in TNE's chart. There's been every year up until about 2023-24, a pretty standard trading band that TNE moved in. When the market got upset, it dropped around to market average. When the market was excited, it got up to sort of double market average, which is kind of a normal trading band. And then suddenly, Mr. Market wanted to make you pay 5, 6, 7 times the market average for a company as wonderful as TNE. And my argument or comment would be, there is nothing worth paying that many times above the market average, because at some point something will turn and it will be, by definition, the market average again. And that's exactly what you're starting to see in price.
All right, Nick, how do you avoid paying for quality when the market has fallen in love with the company? And you actually quite like the earnings story as well.
Yeah. I mean, you've really got to come back to your first principles. And for us, it's, be patient and stick to your discipline, because we've seen over the last, say, maybe 5 to 10 years, this massive PE increase in high quality companies. We used to pay, say, for TechnologyOne, maybe 30 or 40 times earnings, whereas, as Andrew said, it went to 100 times earnings. A company like Pro Medicus traded on, I think, 200 times sales. So in these scenarios, we've got to be really, really careful, because as sort of high quality investors, these are the companies we want to own, but we can't own them at any price. And what's been exciting over the last, say, 6 weeks to 3 months is a lot of these companies are actually coming back in price and back in valuation and are starting to look interesting. TechOne and Pro Medicus probably aren't quite there for us yet, but they are getting more and more interesting. And these are the opportunities that price volatility provides. And so ideally, as Andrew said, you do want to have a business where you have stable earnings growth, as TechOne has, but you have massive deviations in its valuation. And when Mr. Market gets a bit down on the company, that can be a real opportunity. And there's plenty of those out there at the moment, probably more so internationally. But there's a few domestically as well. As we mentioned, the classifieds is one space we're pretty interested in.
All right. So, Nick, I have to ask you, because clearly you've got to do your homework to get this right. In the next sharp market sell-off, which we are destined to have, what should investors look at first? Share price or the earnings?
Okay, it's a really good question. I think in any sharp market downturn, you really need to look at the earnings first. Investors really need to assess whatever X event may be. Let's say it's COVID, and then make a judgment to has this event changed the company's earnings? And that really requires knowing the companies quite well. And is the change permanent or temporary? And that sort of separates, I think, the noise and the fundamentals. A lot of times we can be guilty of just looking at share prices and thinking the world's going to end when earnings actually hasn't changed a whole lot. That's not to dismiss share prices. I think they're you've got to be humble enough to and believe in the efficient market a little bit to understand that share prices, particularly if they're moving in isolation, can signal that you may have missed something. And so it's important to go back and do your homework. So I wouldn't dismiss share prices, but our focus is really earnings. And in a sharp correction, particularly, we want to go back to the fundamentals of those companies and see if anything's changed. And if nothing's changed, or if it's going to be a temporary blip in earnings, that can be a real opportunity.
Got it. Same question to you, Andrew.
Well, it's earnings, but I think what's really useful is to use that sort of 4-box analogy that Hans Rosling coined in his book Factfulness, which is to say that as humans, we're really usually bad at making decisions because we answer either is something good or bad, or is it better or worse, and we forget to ask the other question. So what I would ask in any form of correction, and I'd say this works on the upside too, is the earnings objectively good or bad, and are they better or worse than where they were? And from a share price point of view, does that make this a good or bad investment? Not just is it a better or worse investment than it was before it dropped? Because in the end, in the long run, we want to be as objective as possible. We want to own wonderful businesses at reasonable prices, not wonderful businesses at a 5% discount or awful businesses on an 80% discount.
Got it. All right. Nick Cummings from InvestSMART, Intelligent Investor. Really appreciate you joining us. Love to have you back sometime. And Andrew Coleman is sticking around after the break to answer a question from viewer Jonathan. Well, let's get to our viewer question, and that comes from Jonathan, who writes, how do you view sentiment? As in, sometimes fundamentals can be strong, but the market just doesn't like the stock or something about the story. Do you ever allow market sentiment to change your thesis? Thank you, Jonathan. So, Andrew, how do you answer that?
The short answer, Jonathan, is you shouldn't. If your thesis is a good thesis, then what other people think about it should be irrelevant, right? Like if it objectively is the correct answer, then just because there's a whole bunch of other people yelling the emperor has clothes, it doesn't mean you ignore the evidence of your own eyes. I think, though, that is, as a human, the hardest thing to do about value investing. And therefore, I think it's a very good question to ask, because it's very difficult to maintain that intestinal fortitude to keep backing a thesis that you think is right when you see everyone else yelling, it's wrong, and the market moving in the opposite direction, whether that's a rising share price that you don't understand or a falling share price that you don't understand. And I think, from a Teaminvest point of view, we're really lucky because we've got a bunch of tools that we've built that help us stay objective on that. And in particular, what I'm thinking there is our valuation software, which is called Conscious Investor, and the concept of both the STRET-D, so our expected return, and our fear and greed index. And what those really are is they're saying, objectively, if this scenario plays out, what do I stand to make, my expected return? And then separately, where within the trading band of this company's history of PEs is the market currently? Is the market fearful or greedy? Because that way it helps you answer that question of, if my thesis is good and the market is being really fearful, I can hold the line. On the other hand, if my thesis is questionable and the market is really greedy, perhaps that's a time to say, maybe the market's going to be right, sell, take the profit, and move into something else with a better return and lower risk.
Yeah, well, interesting. I think that will be a theme for another episode, when to sell, because everybody's always wondering. Andrew Coleman, we'll have to leave it there for this week. Thank you for joining us. And thank you for watching Wealthy and Wise. We'll see you next week.
Wealthy and Wise is your guide to value investing, powered by Teaminvest.